What's up everybody, and welcome back to the Intro to Investing series here with VectorVest. So you want to know exactly how much you should be risking on any given trade that you have in the market? Well, if you just want a straightforward answer, it's 1%. 1% is the absolute most of your portfolio that you should ever risk on any given trade. If you want to know about a little bit more details, stay along for the rest of the video. Let's get started. What's up everybody, I'm Clayton here with VectorVest, and in the previous video we talked about diversifying your portfolio so that you don't risk too much on any given investment. So what does this mean in terms of actual risk? How much should you be risking of your portfolio in dollar terms, in percentage terms? Like I said before at the beginning of this video, it's 1%. So if you're dollar weighting your portfolio, if you have, let's say, a $10,000 portfolio and you're buying 10 different stocks, these are well diversified stocks, they're not all in one sector, they're not all in one industry, and your entire portfolio certainly isn't in one company. So where do we go from here? How do we determine what our stop loss should be? With all of the different types of stop losses out there, trailing stops, trading stops, ratchet stops, hard line in the sand, buy rating, sell rating, hold rating, all different types of stop losses that you can use, you need a golden rule. You need that line in the sand to say this is absolutely the maximum that I'm willing to risk on any given position at any given time. And it's so simple to remember, it's 1%. So how do we calculate this 1%? In the portfolio I mentioned before, we say that we have a $10,000 portfolio, and if that sounds like a lot of money to you, this applies to any size portfolio you have. Whether it's a $100 portfolio and you're looking at getting into maybe 5 different positions of $20 a piece, or you've got a $100,000 portfolio and you're investing $10,000 per stock, this 1% applies to you. So how do we calculate it? Let's take the example of our $10,000 portfolio and we have 10 different positions. This means that we're able to invest $1,000 in any given stock or any given ETF or investment. So with $1,000 invested into each stock, how much should you be willing to risk on that particular stock before you reach that 1% of your portfolio limit? If you answered 10% of that particular stock, you're correct. So how do we get this? 10% of your $1,000 investment would be $100. You're willing to risk $100 on any given investment in that portfolio. So that turns out to be a maximum loss of $100 on your $10,000 portfolio. And as we all know, $100 into a $10,000 portfolio is 1%. So what is this 1% rule going to allow you to do? It's going to allow you to take advantage of the full upside potential of a stock. It's going to allow that stock to run higher and higher and higher, and it's still giving it some great wiggle room to go to the downside or to pull back a little bit as well, because a 10% stop is not too tight on any given investment. But look at the upside. It limits your risk on your portfolio to only 1%, while allowing unlimited upside potential. Think about this. What other type of investment out there limits your risk to just 1% but allows for unlimited upside potential? I know a lot of investors are going to be pushing real estate and so forth, but there's no such thing as limiting your risk in real estate to only 1%. Trust me, I've had some real estate investments. I know a lot of people who do real estate investing, and just the unexpected expenses and the unexpected problems that arise in real estate are going to account for much more than 1% of your investment. No matter how nice the neighborhood or no matter how nice the house is or the apartment is that you buy, you're always going to have those unexpected and expensive problems that arise. In speaking to diversification that we talked about in the last video, let's say you only have a $100 portfolio. Maybe you've started out and you're investing on one of those apps that doesn't charge any commission. You've got a $100 portfolio and you've decided to go the ETF route. Well, okay, we do like to diversify, and we always recommend having more than one position in your portfolio. But if you've just started out and you only have one position in your portfolio, and it is a diversified ETF, so it's getting you into a little bit of everything. It's not just investing the whole ETF in one sector, one industry, one company, one country, one currency. It's nothing like that, but it's a basket of stocks that you're investing in, so you technically are diversified. The same applies. You never want to risk more than 1% of that portfolio. So you have a $100 portfolio, but it's all invested in one ETF. Now, of course, this gets a little bit trickier because the ETF could swing drastically. But if you're investing in an ETF that's very volatile and you only have $100, maybe it's my personal opinion, but I don't think you chose a very diversified ETF. If you only have that sort of money and you're investing 100% into one ETF or one position, you need to make sure that it's a very steady, rising ETF and that it doesn't have those volatile swings that'll stop you out of a position almost immediately upon getting in. When you have that line in the sand drawn, it's going to allow you to invest without emotion. You're not going to be faced with the decisions of, should I sell this position? Is it time to get out of this position? No, because you've already determined your line in the sand and your sell point before you even bought the position. And trading without emotion is probably the absolute best thing an investor can do. And think about it, if you're only risking 1% of your portfolio to begin with, how emotional can you really get? If you can't afford to lose 1% of your portfolio, I don't know, maybe this isn't the time for you to be investing. But if you're okay with that 1% loss with unlimited upside potential, then this is an excellent rule to apply to your portfolio, to your investments, so that you can move forward knowing exactly when to get out of a stock. You know, I forget where I read it, but it's been brought up to my attention recently that knowing when to sell a position is the number one question among investors today. They buy the positions, they get into a good stock, but they face the dilemma of, should I sell? Should I take this gain? Has it gone down too far? Should I limit my losses now? This is exactly why you need to have a trading plan going into every trade that you make, every investment you make. And this is a perfect example of how great this series is, not only for brand new investors, but for investors that have been seasoned, that have been around for such a long time, but still struggle with this. In the previous videos, we've already learned exactly when to buy, what types of stocks to buy, when to sell them. We know that we need a diversified portfolio, and now we know that 1% is the magic number that we should never be risking on any one position, because this allows us to limit those losses, to pick ourselves up, and to invest again tomorrow. Even if we experience losses on our investments that we currently have, we're still allowed to move forward. We still have the capital to move forward, and we have the means and the emotional strength to continue investing in the market, knowing exactly what our risk to reward ratio is, and that we're something we're comfortable with, knowing that, okay, well, I'm going to limit my risk, or I'm going to limit my downside potential to $100 on this investment, but I can make $1,000 if it continues to go up. This is an excellent 10-to-1 risk to reward ratio, and it's almost impossible to find in any other form of investing or in any other assets. That's why the stock market is so beautiful, guys, because you can limit the downside risk. A lot of people equate it to gambling, but it's nothing like gambling. When you're able to limit the risk that you take on, but allow the rewards to be endless, think about the possibilities that come along with this. So to sum it all up, guys, it's as easy as possible to remember. You never want to risk more than 1% of your entire portfolio on any given position. So do the math. It's very simple. Whether you have 5 positions, 10 positions, 20 positions in your portfolio, you want to limit the total risk on that portfolio to only 1%. So if this advice could have been helpful for you, maybe you made a trade that you lost more than 1% on and it took you a while to recover and get back into the market. I want to hear your stories. Let me know in the comments below if this 1% rule would have been helpful for you, or if you're investing going forward and you're going to apply this rule to save your portfolio from any downside risk. And as always, guys, if you're not a part of the VB Nation already, if that subscribe button is red, please click on it, join the VV Nation, share this video with your friends because I'm sure they're out there investing and I'm sure they're allowing their portfolios to just run wild. So let them have a little bit of good advice. Share us with your friends. Don't forget to click that like button. And as always, guys, I hope you have a great day.